I'm going to talk about the risk I started seeing, why the old playbook broke, what I changed when I saw it building, and how the portfolio is built now. A few years ago, I started noticing a trend that made me somewhat uncomfortable. Not with the markets, those have been doing fine. It was with what was starting to creep into portfolios that I was looking at. On the surface, everything looked fine. People had global funds, US funds, some of them had balance. It all was looking very grown up and responsible. On their statement, it was the kind of portfolio that should let you fall asleep at night. But as I take a look under those layers, past the names that are on the statement, I was starting to see this creep come in that made me nervous. There were different logos on the funds, there were different fund managers, but the same group of stocks kept showing up again and again. Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla. It didn't matter if it was a global fund or a US fund or a Canadian fund or even a balanced fund. These all held the same thing. And at first, that doesn't sound so bad. They were great companies. They've grown a lot. But I've had this realization that changed how I felt about how this was all going for my clients' retirement plans. If all those funds are holding the same thing, who's left to buy it when people need to sell? That question really stuck with me. Sometimes markets don't fall because companies suddenly became bad. Sometimes they fall because people get scared and need liquidity. And when that happens, the first thing that gets sold aren't the ugly, illiquid companies that nobody wants. It's the good ones, the famous ones, the ones that trade easily. And right now, that's what everyone owns. So if no one is buying those and everyone is selling, your prices don't just drift down, they fall, and they fall fast. And that means the very stocks that made people feel safe, that grew the most, are also the ones that are going to make the biggest hit when something breaks. I'm Franz Vickerson. I'm an advisor located in the Vernon area in BC. I look after BC and Alberta, and in a minute, I'm going to show you exactly how I've been rebuilding portfolios to deal with this very concern. But first, you need to understand why the old playbook is broken. This isn't a theory. We've watched it happen before. Some of those examples, things like in Canada learned the hard way with companies like Nortel. The US learned it during the dot-com bubble. There are companies like Cisco. They were invincible until they weren't. Every big technological revolution starts with something wonderful, attracts a huge amount of money, a huge amount of optimism, and then we start building infrastructure. And every time we start building infrastructure, we seem to build it way too quickly. Eventually, reality catches up. Demand and supply start to go offside. Your supply will outpace your demand. It always has so far. There's a good chance it does going forward. This time, though, the stakes feel higher because there's something new in the mix. There are other things to consider. We have uncertain politics. We have tariffs. Countries are pulling back from each other. They're rebuilding and reshaping their supply chains. Markets aren't just reacting to earnings anymore. They're reacting to headlines. And headlines have this nasty habit of showing up at 3 a.m. when nobody's watching. At the same time, some of the old strategies that people relied on are starting to fail. For decades, bonds were supposed to be the boring, dependable part of a 60-40 portfolio. Stock would zig, bonds would zag. That was the deal. But inflation has broken that relationship. We just lived through a period where stocks and bonds fell together, which is not how most people thought their retirement was supposed to feel. And this is the part that really bothered me. A lot of these portfolios were never adjusted for any of this. I meet new clients all the time. I open their accounts and I can see it immediately. Things were set up years ago. Maybe when rates were lower, when paychecks were smaller, when the world felt more predictable. And then they were just left alone. There was no rebalancing. There was no trimming of risk. No one saying, hey, this is getting a little lopsided. So people sit there with $1 million, $2 million invested, watching the news, feeling uneasy, just wondering why their advisor only seems to call when there's paperwork to sign. That's a real problem. It's not that the markets are dangerous, it's that nobody's really watching them for you. And while most of the world was glued to the news, watching markets bounce around and trying to guess what would happen next, I was doing something much less exciting. I was taking apart the portfolios, not in a dramatic way, but in a slow, methodical, slightly obsessive way. I did it over a couple of years. Because what I started noticing wasn't that markets were going up or that technology was doing well. Those things are fine. What bothered me was that the same exposures were quietly creeping into almost every portfolio I touched. Global funds, US, international, or even balanced. Again, different names, different managers, but when I opened them up, it was the same group of stocks showing up again and again in their top 10 holdings. So I did what I always do when things don't make sense. I'm very analytical. I measured it. How much of this portfolio was really in the US? How much was in large cap tech stocks? How much was actually international? How much was truly Canadian? What I saw in the beginning wasn't dramatic. It was subtle. And that subtlety is how risk sneaks up on people. So, over the last couple of years, while markets were still doing well, I started making small adjustments to my clients' portfolios. We weren't pulling out of the US. We weren't abandoning technology. We were just slowly reducing our concentration and rebuilding real diversification. We did it with geography. We did it with company size. We changed the income sources, and we diversified with different growth engines. I realized that's how institutional portfolios are managed. They're not waiting on headlines. They're managing their exposures actively over time. And thank God I did it. My clients, here we are in 2026, and that concentration risk is worse than it was back then. Once I started managing money this way, my portfolio stopped looking like a pile of funds. They started looking like a system. For me and my clients, that system is built around 12 distinct sleeves. Each one has a job. On the income side, I don't rely on just bonds anymore. I use a global tactical income sleeve that can move between credit, currencies, and different yield strategies. I use Canadian corporate bonds that have some great yields that can be maintained over a few years. I have Canadian dividend equities for stable cash flow. I also think they'll take advantage of a lot of this transition that's happening because of that cash flow. And I use a volatility and option-based sleeve that actually earns more when markets are nervous, cashing in on market fears. That combination gives us something traditional portfolios don't: a steady stream of income that isn't dependent on interest rates alone. It creates a buffer so that when markets wobble, we don't have to sell growth assets just to pay the bills. My next step is that I have a growth engine. I hold a global value tilted equity sleeve. It avoids the high multiple earning US mega caps. It has compounded around 10% for decades. This is my tank. It's where I save profits from other areas so that I can redeploy at a later date. I hold a broad US equity sleeve. I pair it with a US mid-cap sleeve because smaller domestic companies often benefit when rates come down, and during trade wars that favor local production, these domestic companies are less exposed. I also hold a pure international equity sleeve. It doesn't leak back into the US, which was surprisingly hard to find. Hey, that gives us real geographic and size diversification instead of everything just leaning on the same giants. A little bonus stat: the US mid-cap market, the S&P 400, compared to the S&P 500 since the year 2000, the 400, the mid-size, has a higher average return. Then there's what I call the wildcat sleeve. This is where I go looking for returns that don't come from the S&P 500. I use a green energy and green transition sleeve that benefits from things like new battery technology, industrial upgrades, companies becoming more efficient and profitable as they're cleaning themselves up. I use a global small cap sleeve, which benefits from interest rates falling around the world. I also use a global micro cap sleeve, and this gives us exposure to private equity takeovers, where you often get big buyout premiums. To give you a sense of what that means, if you think about company size, you have large caps, then mid caps, and small caps. The global small cap is at the top end of that universe. The micro cap sleeve is at the bottom end of that universe. And those are the companies that private equity loves to buy. I also use a non-US technology sleeve run out of Asia that has a very different exposure than Silicon Valley and happens to be extremely tax efficient in my non-registered accounts. So that's 12 distinct sources of return, not 12 funds that all own the same stocks, 12 genuinely different engines. And then we don't just hold them. We rebalance them. When US tech runs too far, we trim it. When international lags, we can add to it. When income piles up, it becomes dry powder for the next opportunity. That's how I'm trying to turn volatility into something that's working for us instead of against us. I'm not trying to predict the future. I'm trying to be ready for whatever the future brings. I'm trying to build a portfolio that doesn't break when the world gets uncomfortable, because the people who do best over time aren't the ones who guess right. They're the ones who don't get forced to sell. And that's what this entire approach is designed to do. Thank you for watching.